Hi everyone, you are on the channel Brothers Wall Street. This channel is everything about the market, economy, and investment. I have a quick disclaimer for you. Everything that you see here is not a financial advisor. So let's get started. The main topic for today is why are technology stocks falling, like Amazon, Google, Apple, Microsoft, Nvidia, Meta. What is going on in the market? Based on our research, there are only four reasons why it is falling. The first one is recession, second one stagflation, third inflation, and the last one low future profit expectation. If for some reason you don't understand these fancy words, no panic. I will go into more details in this video for you later. So stay tuned and let's go. Tech stocks have a huge impact on S&P 500 and Nasdaq index. For example, these six stocks have a 20% weight on S&P 500 and a 40% weight on Nasdaq index, and the weight size for each stock is consistently changing based on their earnings performance. For example, at the same time, Meta has a 0.67 weight size in the S&P 500 index. However, the last year it was 3.5%. If something bad happens to a stock, big institutions will sell it immediately without hesitation. Should you do the same? Well, at least you know how it works and how you can manage your portfolio to make the right decision. You may find it on slickchart.com. This is where you can find the weight percentage for each stock in the index. So, how does the recession affect technology companies? Most negatively. Are we now in recession? Technically, yes, we're in recession. Recession is a part of the economic cycle. During the recession, technology companies, for example, Amazon, Google, Apple, have a lower business production, losing billions of dollars on the stock market, cutting costs and cutting jobs just to show some profit on the income statement and not to scare investors. Increase expenses in the long term because for technology companies to be competitive in a market, they must consistently improve their technology and upgrade their services. And the worst scenario for technology company is bankruptcy and out of business. The next lower business cycle after the recession is stagflation. Stagflation is an economic cycle that is characterized by slow economic growth, a high inflation above 5%, and high unemployment rate. A lot of analytics thinks that we are in a stagflation, however we are not. And let me explain to you why. GDP for the last couple of 3 quarters is kind of choppy. It is going down, then up. It is because of COVID-19, supply chain issues, increased cost of goods, and the Ukrainian-Russia war. However, on the 10-year chart, we see a steady uptrend. There are going to be two more GDP reports on November 30 and December 22 this year. Currently, we have high inflation around 8%. However, the month-to-month change is already decreasing. More likely, inflation is going to stay above 5% for the next full year. The unemployment rate is currently below 5% despite the aggressive monetary policy, so we're not in stagflation right now. Now let's talk about the interest rates. COVID-19, supply chain disruption, increased cost of goods, the lockdown in China and the Russian invasion in Ukraine has to let the worst inflation rates in decades. Fed has been raising rates already for 6 meetings. The chair of Fed Paul admits high inflation and raised the interest rates by 0.75% up to the current interest rates of 4%. The next meeting is going to be on December 14. More likely they continue raising interest rate by another 0.5% until the inflation will slow down. The high inflation hurts all sectors of the economy and consumers because of the high cost of production and expensive labor. On next slide, let's talk about how the strong dollar affects the market. The strong dollar is strengthening because of the Fed adopted an aggressive monetary policy in response to high inflation. The US economy looks much better than any other advanced economies, including Canada, Australia, European area, the United Kingdom, and Japan. Remember, foreign investors will not sit tight and see how their investment portfolio shrink. Money goes where the money grows. Global investors start aggressively investing money into US dollar to save their portfolios from the weak currencies. They are selling off the currencies, weakens their value. However, retail companies and consumers are benefiting from the strong dollar who buy foreign goods and services abroad. Imported goods become cheaper to purchase in other countries. For example, Walmart, Target, Costco, Home Depot, Lowe's, and so on. The dollar's strength negative affect global currencies, cryptocurrencies, technology stocks, bonds, and the real estate market. Microsoft, Amazon, Google, and Meta are also struggling because of a strong dollar. Up to 40% of sales are made abroad on weak currencies, and when they convert weak currencies back to dollar, it results in lower profit. So let's right now talk about the Apple. Apple is a big tech company. Gross revenue $394 billion, net income $99.8 billion. The most revenue comes from the sale of the iPhone. They make money also from selling iPads, Macs, and accessories and providing services. Next company is Microsoft. Microsoft is a leader of Windows application. Gross revenue 50 billion, net income 17 billion. Most money come from cloud services, Microsoft Office, Windows, and other applications. Google is the leader of Google Search. Gross revenue 69 billion, net income 13 billion. Majority of money come from Google Search, YouTube advertisement, Google Network, and others. Amazon gross revenue 127 billion, net income 2.8 billion. Majority of money comes from online stores, seller services, subscription, advertising, AWS, cloud, and others. And the last one is Meta, gross revenue 27 billion, net income 4.3 billion. The majority of money comes only from advertisement. Well, folks, that's all for today. I hope you like it. Please hit the like button and let me know what you think about it in the comments below. To see more videos like this, please consider subscribing it. Thank you, bye.